Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Tuesday, the 29th of November. I'm Daniel Lam, your host for the podcast. Yesterday, right at the Hong Kong market open, I had reporters asking me to comment upon the sharp fall in the Hang Seng Index. Of course, many were getting used to the sharp rises in the index over the last few weeks and forgetting about the sharp falls back in October. We last spoke about the Hang Seng Index exactly 2 weeks ago in this podcast, and I did highlight that the index was prone to correction after running up nearly 4,000 index points from the bottom. The level mentioned was 16,700, which was nearly reached yesterday. And subsequently, there was buying with high volume for the rest of the day. Now, the rise in COVID cases in mainland China was naturally highlighted as the main reason of the weakness at the open. But as we all know from the global experience, no normalization from COVID was free from volatility in the markets. So, should investors be concerned about a deeper fall in Chinese equities? Our view is that there could be further correction, but a much deeper fall is not so likely. So first of all, reopening is likely to continue. Yes, the winter season makes reopening tricky to manage, but the general direction is likely to stay. Secondly, is policy support, which has been happening every week for the last few weeks, such as the backstop on the property sector and RRR cuts. The critical Central Economic Conference in December may provide further guidance on this front. Thirdly, the US dollar. Now the DXY index is trading around 106 and oversold in the short term. There's room for the index to rebound to technical resistance around 110.80 as we are running to another FOMC in the middle of December. However, such rebound may be short-lived as the recent US CPI inflation data has started to slow and FOMC minutes starting to show some dovishness. I will reiterate the analogy that I used in the podcast 2 weeks ago, that the Hang Seng Index is behaving like a marathon runner. It needs a rest and needs to, quote-unquote, catch its breath before attempting to speed up again. So technically, this pullback is a very healthy development. So at around 16,700 to 16,900, which is roughly 61% Fibonacci level, between the recent range, it is a good area for investors to buy into the Hang Seng Index, which may retest 18,400 before year-end. Watch out for the communication services sector, which had delivered very reasonable earnings over this month. This sector comprises many of the internet names, which have started to emerge from the weakness caused by the regulatory saga over the last 2 years. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.